How does gamma risk relate to implied volatility? Have you ever wondered how gamma risk connects to implied volatility in options trading? Understanding this relationship can be key to managing your risk effectively. Let's break it down. First, let's clarify what gamma and implied volatility are. Gamma measures how quickly the delta of an option changes when the price of the underlying asset moves. Delta tells us how much an option's price is expected to change with a $1 move in the underlying asset. Gamma is highest for at-the-money options and decreases as options move further in or out of the money. Now, implied volatility reflects the market's expectations about future price movements of the underlying asset. It plays a significant role in determining option prices. So, how do gamma risk and implied volatility interact? They actually have an inverse relationship. When implied volatility rises, gamma tends to decrease. This happens because higher implied volatility means options have more extrinsic value. As a result, the delta becomes less sensitive to changes in the underlying asset's price. On the flip side, when implied volatility drops, gamma increases, making the option's price more responsive to price changes in the underlying asset. This relationship has a direct impact on option pricing. As implied volatility rises, option prices generally increase due to the heightened uncertainty about future price movements. However, this increase in implied volatility reduces gamma, which means the delta of the option is less responsive to price changes in the underlying asset. Understanding this relationship is essential for effective risk management in options trading. For example, traders who are long options benefit from high gamma when volatility is low. In this scenario, small price movements can significantly impact the option's delta. Conversely, when volatility is high, predicting how options will behave becomes more challenging due to lower gamma. Another important factor to consider is the time to expiration. As options approach expiration, gamma for at-the-money options increases. This makes them more sensitive to price changes. Near expiration, changes in implied volatility have less impact on gamma, as the option's behavior becomes more binary, either into money or out of the money. In summary, grasping how gamma risk relates to implied volatility is vital for managing volatility risk in options trading. By understanding this interaction, traders can better anticipate how their positions might react to market changes, leading to more effective risk management strategies.